Someone is going to tell you today that all you need to do is just buy an S&P 500 index fund. And they're right. They're also completely useless. Because if you have $500 in your account right now and someone tells you to dump it into the S&P 500 for an 8% annual return, congratulations, you just made $40. $40. That is not a retirement plan. That is not even a Chipotle burrito anymore, not at 2026 prices. The problem isn't the advice. The advice is technically correct. The problem is that correct advice given to the wrong wallet size produces exactly zero results and a lot of resentment. And here's what nobody actually talks about. The psychology changes completely at every single level of wealth. The $500 investor thinks differently than the $50,000 investor, who thinks completely differently than the $500,000 investor. Same market, completely different game. Same compound interest formula, completely different emotional experience of watching it work. So today, we're going to walk through exactly how investing evolves as your wealth grows, from $500 all the way to $1 million. And yes, I will explain why $1 million in 2026 buys you a studio apartment in a zip code where the Yelp reviews include the phrase, "saw a needle." Let's get into it. Level 1. You have somewhere between $500 and $5,000 to your name. Maybe you just landed your first real paycheck. Maybe you finally killed that credit card, which, for the record, was charging you 29% interest, so congratulations on defeating a financial weapon of mass destruction with your bare hands. Here's what the math actually looks like at this stage, and it is brutal. 8% annual return on $500 is $40 a year. Your brain, your human, evolutionarily wired for survival brain, physically cannot process $40 as a meaningful reward for 12 months of patience. It can't. Delayed gratification was a useful survival trait when you were running from predators on the savannah. It is significantly less useful when the end reward is 2 large pizzas with a $2 tip. And this is precisely the moment people make catastrophically bad decisions. This is the stage where you find a coworker on his 3rd cup of coffee explaining why Dogecoin is actually undervalued right now. This is where you discover 0 DTE, options, 0 days to expiration for those of you fortunate enough to know what that means, which is essentially Wall Street bets degeneracy repackaged as a trading strategy. Technically, you can turn $500 into $50,000 in a single session. You can also turn $500 into a screenshot that gets 47,000 upvotes and a moderator's sympathies. The market does not care about your intentions. The meme coins are even worse. At least options are tied to real companies. Meme coins are tied to a picture of a dog and the collective delusion of people who refer to panic selling as weak hands. People at this stage are not investing. They are gambling with a thin layer of finance vocabulary on top. And look, I get it. I genuinely do. When $40 a year is your realistic market return, the psychological temptation to swing for something bigger is almost overwhelming. The math is insulting. The math deserves to be insulted. But the answer is not to blow your capital at the casino, it's to change the math. Here's the real advice for this stage, and Warren Buffett, who knows 1 or 2 things about compounding, backs this up completely. Buffett bought his first stock at age 11, but what he preaches to people who are still in the early wealth-building phase is this: until you have meaningful capital, your greatest investment is in your own earning power. A $300 certification course that earns you a $15,000 raise has a return rate that would make a hedge fund manager put down his sparkling water. So at this level, high-yield savings for your emergency fund. Yes, they still exist. Yes, rates have been all over the place, but a 4 to 5% HYSA still beats leaving money to rot in a checking account. Fractional shares in broad index funds, VOO, SPY, something boring that tracks the market, with whatever you can afford to leave untouched. And most importantly, invest ruthlessly in skills that increase what you earn. The avocado toast take, by the way, has been thoroughly mathematically destroyed. The idea that cutting brunch is what stands between you and home ownership is one of the more condescending things that's been said in personal finance, and that is an extremely competitive category. Skipping coffee isn't going to help you afford a $750,000 starter home in a market where mortgage rates have done things that would make a 2019 home buyer physically ill. The actual move is increasing income. That's it. That's the unlock at this level. But here's the thing. Once you scratch your way past $5,000 and push toward $10,000, the enemy changes. It's no longer desperation. It's something much quieter and, honestly, more dangerous. It's boredom. Welcome to what I call the boring middle. $10,000 to $50,000. You now have what financial advisors call an emergency fund. You have what normal people call money in a savings account that I have seriously thought about touching 14 times this week. You are no longer completely broke. You are not rich. You are, my car broke down and I didn't immediately spiral rich. You are F my car broke down money rich, not F you money rich. This is technically progress. Now, this stage has a villain, and the villain's name is Dave Ramsey. I don't want to be unfair to Dave Ramsey. The man has genuinely helped millions of people escape debt. His baby steps framework works. The philosophy of clearing high-interest debt before investing aggressively is correct, but somewhere around step 4, a cult forms. It is the rice and beans phase. Dave will instruct you to eat rice and beans, drive a 2004 Toyota Camry with a check engine light you've named Dennis, and funnel every dollar either toward debt payoff or index fund investing. Cut up your credit cards. Live like no one else now so you can live like no one else later. And again, he's right. It's just that right is genuinely soul-crushingly boring. And boredom is the actual enemy at this level, because this is the stage where people break. They watch their account number creep upward like continental drift. They see colleagues pulling up to the office in new Teslas. They've been disciplined. They've done everything correctly. They've eaten the metaphorical rice and beans. And something snaps, and they think, I deserve this. I am something of a financial genius myself. And they finance a $65,000 vehicle on a 72-month loan and set their net worth back by approximately 18 months. I am not judging. I am describing a pattern that has a near-perfect recurrence rate. Here is the actual strategy for this level, and it is two things: automation and tax advantages. If your employer offers a 401k match, let me be extremely direct with you. That is free money. That is your employer offering to hand you additional compensation that you have to do essentially nothing to receive. Not participating in your employer's 401k match is the financial equivalent of your boss walking to your desk, holding out a $50 bill and you saying, "Actually, I'm fine." The match alone is commonly a 50 to 100% instant return on your contribution. There is no investment in the known universe that guarantees that. Beyond that, Roth IRA. If you're eligible based on income, max it out. The 2026 contribution limit is in the neighborhood of $7,000. You put in after-tax dollars now, every dollar of growth, every dividend, every capital gain, every year of compounding comes out completely tax-free in retirement. The IRS does not get a cut. It's one of the very few moments in your adult financial life where you will feel like you actually won something. Set up automatic weekly deposits. Make the whole process as painless and invisible as possible. The goal at this stage is to make investing boring enough that you forget you're doing it. And then one day you look up and something mathematical has quietly occurred. The snowball has started rolling. But it's slow. It is genuinely, objectively slow. And the reason it's slow is the reason the next level changes everything. Once you grind your way past $50,000 and start approaching $100,000, you're getting close to the moment that people who have built wealth look back on as the turning point. And it involves a quote from a man who was simultaneously one of the greatest financial minds of the 20th century and not particularly interested in being polite about it. Level 3. $100,000 to $250,000. Charlie Munger, Rest in peace to a man who made billions and never once softened the sentence to spare your feelings, said, and I want you to actually absorb this, the first 100,000 is a bit, but you gotta do it. That's the lesson. 7 words. That's it. The first $100,000 is not a math problem. It is a psychological endurance test. It is years of correct, boring, unsexy decisions. It is the long, slow accumulation of a number that doesn't feel real until suddenly it does. And then the math changes. A 10% market return, which is roughly the historical average of the S&P 500 over long time horizons, on $100,000 is $10,000. You did nothing. You slept, you watched television, you had a minor crisis about something completely unrelated to your finances, and the market, that indifferent, impersonal machine, handed you $10,000 as if it were completely normal. Because at this level, it is. $10,000 is rent in most American cities. It's a semester at a state university. It's the kind of number that 1 or 2 levels ago would have felt like an enormous financial event. Now it's just a Tuesday. That is compound interest finally waking up. That is what Munger meant. The first 100,000 is brutally slow because the math hasn't kicked in yet. After that, the math starts doing the heavy lifting. Now, at this level, the strategy needs to evolve. You can absolutely keep riding the index fund wave, and honestly, for most people, that remains the single most intelligent thing you can do. But this is where intelligent diversification enters the picture. Real estate is the most common next move, and the specific strategy I want to highlight is house hacking. You buy a duplex. You live in one unit, you rent out the other. Your tenant, a person you will from this point forward reference in conversation with a very particular energy, effectively subsidizes your mortgage. Your housing cost drops dramatically or disappears entirely. You're building equity in an appreciating asset while someone else pays for it. This is not a loophole. This is how property has built wealth for generations. REITs, or real estate investment trusts, are the version of this for people who don't want to own property directly or deal with a tenant texting them at midnight about the hot water. You buy shares in a portfolio of real estate that pays dividends. Less leverage, less drama, more liquidity. But more than any specific investment vehicle, what changes at this level is the mindset. You stop thinking like a saver, where do I put this to keep it safe? And you start thinking like a capital allocator, where does this money generate the most output? That mental shift is genuinely the dividing line between people who stay middle class and people who don't. And once you push past $250,000 and start approaching 500,000, the game changes again. Not in the way you'd expect, because the emotion at that level isn't excitement. It's something closer to anxiety. Here's what I mean.
Welcome to the stage where the wealthy get paranoid. At $500,000 to $1 million, something happens psychologically that I don't see discussed enough. You flip completely. You spent years playing offense, grinding, automating, compounding, stacking. And then one day you have a number in your account that makes you unconsciously aware of how much you have to lose, and your brain quietly switches modes. Now you play defense. Paranoid, sophisticated, deliberately boring defense. The first and most powerful enemy at this stage is taxes. Capital gains tax, the tax you pay when you sell appreciated assets, can run to 20% at the federal level for long-term gains. Stack on state taxes in places like California or New York, and you're looking at rates that make you lie awake doing arithmetic at 2 a.m. For the record, the IRS has never once lost sleep over your brokerage account. The asymmetry is remarkable. So, what do the people at this level actually do? They don't sell. This brings us to the most elegant, quietly infuriating strategy in all of personal finance. It is called buy, borrow, die. And that name was not invented by someone on Reddit. Actual tax attorneys use this framework. Here is how it works. You buy assets, stocks, real estate, equity in a business, and you allow them to appreciate. Instead of selling those assets and triggering a taxable event, you borrow against them. You take out a low-interest loan using your portfolio as collateral. You use the loan proceeds to fund your lifestyle. A loan is not income. The IRS does not tax loan disbursements. You pay the interest on the loan, which at this asset level is manageable, and your underlying assets continue to grow untouched. And when you eventually die, the third and final step, the one that is non-negotiable, your heirs receive your assets with what's called a stepped-up cost basis. The cost basis resets to the market value at the time of your death, which effectively erases the capital gains tax that was accumulating across your entire lifetime. This is not a conspiracy theory. This is documented tax code. Elon Musk, Mark Zuckerberg, these individuals have at various points drawn official salaries of $1 a year. $1. They are not eating government-subsidized meals. They are borrowing against asset portfolios worth tens of billions of dollars, living on loan proceeds and deferring their tax liability indefinitely. The strategy is legal, aggressively utilized, and, depending on your political disposition, either a sign of a well-designed tax system working as intended or evidence that something has gone profoundly sideways. That conversation is for a different video, possibly a different civilization. At this stage, you also need professionals, specifically a fiduciary financial advisor. Not an advisor who earns commissions on whatever products he steers you toward, but a fiduciary, someone who is legally obligated to act in your interest and not their own, and a CPA who specializes in high net worth planning. The gap between competent tax planning and mediocre tax planning at this wealth level can be worth hundreds of thousands of dollars over your lifetime. It is not a place to cut corners. The portfolio itself becomes more conservative. You're not taking moonshots. The days of "this could 10x" thinking are largely over. You're buying dividend-producing assets, adding bonds, exploring alternatives. You're thinking about what happens to this money when the market drops 15%, because it will, eventually, and whether you can psychologically and financially withstand that without making a decision you'll regret. Now, about that $1 million milestone, let's be real for a second. $1 million in 2026 is not the number it used to be. It does not come with a yacht. It does not come with a villa in the south of France. By the 4% safe withdrawal rule, the standard benchmark for sustainable retirement income, $1 million generates roughly $40,000 a year, before taxes. In a city where a one-bedroom apartment is running $2,800 a month, this is not quit everything and disappear money. It is, however, substantially better than $40. Look, here's the actual truth, stripped down to what it is. The game doesn't change because the market changes. The game changes because your psychology changes. At $500, you are trying to survive the math long enough to care about it. At $50,000, you are trying to be patient. At $250,000, you're trying to be smart. At $1 million, you are trying to be deliberately, strategically boring. The compound interest formula is the same at every level. It does not care about your feelings. It does not care about your timeline. It does not care that inflation is slowly converting your purchasing power into a memory. It just runs. The only variable you genuinely control is how long you stay in the game, how much of your principal you protect, and how many avoidable catastrophic mistakes you manage not to make. So, open the brokerage account, set up the automation, capture the 401k match, survive the boring middle, cross the $100,000 line that Charlie Munger warned you about, and for the love of everything good in this world, do not finance a vehicle that costs more than your annual income because a colleague looked at you slightly sideways. See you in the next one.